Most people believe blockchain transactions are processed fairly. You press confirm on your wallet, the network validates the transaction, and the blockchain executes it exactly in the order it arrived, right? Well, that's not what actually happens. Because before your transaction is ever confirmed, it enters a hidden competitive system that most users never see. It's a system where validators, bots, searchers, and these invisible algorithms are analyzing transactions in real time. They're deciding which transactions move first, which get delayed, and which become profitable opportunities. Inside Ethereum and other blockchains, transaction order itself has quietly become a marketplace. Bots can literally detect trades before they execute. Validators can prioritize certain transactions. We're talking about entire infrastructures now competing for just milliseconds of advantage. And you want to know the strangest part? Most people using blockchain networks still believe the system is completely neutral. But beneath every single transaction exists an invisible economy, secretly deciding who wins, who pays more, and who controls the flow of information itself. Please note, this video on the channel Blocks Bonds Funds is created for educational and informational purposes only and does not constitute financial or investment advice. Section 1. The illusion of fairness. First come, first served. So we often think of blockchains like a digital queue at a coffee shop, right? First in, first out. But the reality is entirely different. It is not a line at all. It's actually a hyper-competitive, real-time auction. When you submit a transaction, you aren't grabbing a spot in line. You are submitting a bid. You attach a priority fee, which is essentially a tip, and the network processes transactions based on exactly who is willing to pay the most for that exact moment in time. Sequence is quite literally bought and sold. Section 2. The Dark Forest. Inside the Mempool. Now, this famous metaphor was actually coined by researchers Dan Robinson and Georgios Konstantopoulos. They described the mempool as a dark forest. And the reason is because transactions on Ethereum aren't encrypted. Everyone can see exactly what you are trying to do before it's permanently recorded. In this forest, advanced predators, which are really just highly sophisticated algorithms and bots, are constantly scanning the environment. If you expose a valuable trade out there, detection means these automated systems are going to instantly hunt down and extract that value way before you even realize what hit you. Okay, so let's dive into the formal term for this kind of extraction. It's called maximal extractable value, or MEV for short. Think of block space on a blockchain like incredibly scarce real estate. The people who assemble the blocks, the validators, well, they act kind of like digital landlords, because they have this temporary monopoly power to decide what goes into a block and in what exact sequence they can extract rent. MEV is simply the maximum profit that can be squeezed out of a block just by changing the order of the transactions inside it. So you might be asking, how does this actually hurt me? Let's walk through a classic MEV strategy called a sandwich attack. Say you want to buy a large amount of a specific token and you submit your trade. Step 1. An automated bot sitting out there in the dark forest sees your pending trade. It instantly copies your exact move, but it pays a slightly higher fee to front-run you. It buys the token right before you do, which drives the price up. Step 2, your trade executes, but now at a much worse price because the bot manipulated the market just milliseconds prior. Then, step 3, the bot back-runs you. It immediately sells the token it just bought back to you at that newly inflated price. The bot walks away with instant, risk-free profit, and, well, you are left footing the bill. Section 3. The Infrastructure Stack. The MEV Supply Chain. In the early days, users just submitted transactions directly to miners. But not anymore. Now, your intent goes from your wallet straight into the view of what we call searchers. Searchers are these bot operators specifically hunting for MEV. They bundle your transaction with their own predatory or arbitrage trades. Then they hand these bundles over to specialized builders who use super advanced algorithms to assemble the absolute most profitable block possible. Those builders then pass the blocks up to relayers who finally hand them to the validator to put on the blockchain. So it's become this massive, hyper-specialized supply chain. And here is what the modern architecture of that supply chain looks like on Ethereum today. It's known as the MEV Boost pipeline, and it's proposer-builder separation in action. So you have the searchers submitting their private order flows to the builders. The builders then compete in a blind auction, sending their best blocks to the relays. The relays are essentially acting as trusted auctioneers. They verify the bids and hand the absolute most profitable block header to the validator, which is the consensus client. At that point, the validator just blindly signs it to collect their profit. Now, you might be wondering, why on earth was the system designed this way? Well, it was actually a defense mechanism. Proposer-builder separation, or PBS, exists specifically to protect the decentralization of the network. Think about it. If solo, everyday people running validators had to compete with Wall Street-level quantitative trading firms just to build the most profitable blocks, they would go out of business almost immediately. By splitting the roles, any solo validator can just outsource all that hard computational work to specialized builders. This ensures regular validators still get a fair share of the MEV profits without needing to build their own advanced extraction algorithms. Section 4. The centralized extraction economy. Billion-dollar extraction. The proof of all this is right there in the on-chain data. Looking at a real transaction hash on Etherscan, an arbitrage bot noticed a slight price difference for a token between two decentralized exchanges, Uniswap and SushiSwap. In a single, atomic transaction taking just milliseconds, this bot borrowed a massive flash loan, bought the asset low on one exchange, sold it high on the other, paid back the original loan, and just kept the difference. Pure, risk-free profit executed at the speed of light. And it was entirely dictated by who controls the transaction ordering. Now, it's really important to note that not all MEV is purely malicious. It's actually a super complex ecosystem. Things like liquidation backrunning and AMM rebalancing actually help keep decentralized finance markets healthy and correctly priced across the internet. They bring much needed efficiency. But on the flip side, things like NFT sniping, where someone bribes validators to jump the line and steal a cheap asset, or generalized front running, where bots literally steal your exact profitable transaction strategy straight from the mempool and run it themselves, well, those act as a totally invisible tax on everyday users. Over $1 billion. Let that sink in. That is a highly conservative estimate of how much profit has been extracted from users by MEV strategies since 2020. This isn't just some theoretical computer science problem being debated in forums. It is a massive, highly lucrative financial reality operating right beneath the surface of the entire blockchain ecosystem. Section 5. Blockchains versus Wall Street, Speed and Extraction. Let's compare traditional finance with blockchain for a second. For decades, Wall Street firms have spent millions of dollars laying fiber optic cables straight through mountains just to shave mere milliseconds off trade times, all to beat competitors to the punch in high-frequency trading. What we are seeing on Ethereum right now with MEV is the exact same underlying logic, just played out on a decentralized network. Instead of competing for physical server proximity, blockchain bots engage in automated bidding wars, known as priority gas auctions, fighting tooth and nail for the absolute optimal execution speed and placement inside a block. But here is the major systematic risk we need to talk about. Today, this MEV Boost infrastructure we've been looking at accounts for approximately 90% of all blocks produced on Ethereum. Just think about that. While separating builders and proposers definitely protected the solo validator, it also concentrated an immense amount of power into the hands of just a few dominant relay operators and specialized block builders. If a handful of entities control the ordering of 90% of the network, that creates a pretty severe centralization choke point. Section 6. The future of control. Escaping the dark forest. The good news is developers are intensely focused on this, and the solutions being tested right now are fascinating. But every fix adds complex trade-offs. The community is exploring enshrined PBS, which means wiring the builder-proposer separation directly into Ethereum's core code, so we can remove the need for trusted third-party relays altogether. They're also looking into encrypted mempools that would hide transaction details until after they are ordered, effectively blinding the predators. And there are entirely new privacy-first networks being built from the ground up, like SWEV, which attempts to decentralize the block builder role itself. But the hard reality remains. As long as there is visibility and value before execution, highly advanced actors will always find ways to exploit it. Okay, so what should you actually take away from all this? When you use a blockchain today, you aren't just broadcasting a command to some neutral database. You're stepping into a vibrant, adversarial, and hyper-efficient marketplace where milliseconds literally equal millions of dollars. As we move toward a world where global finance relies on these decentralized networks, we really have to ask ourselves a profound question. If the future economy runs on blockchains, who truly controls the order of information itself? Because the answer to that question will determine whether decentralized finance remains open and fair or just becomes another invisible game controlled by the fastest algorithms. Thank you so much for joining me on this explainer. Stay curious, stay informed, and I'll see you next time.